Welcome to the Explainer. I'm absolutely thrilled to have you here today. Look, in this Explainer, we're stepping right into the shoes of an expert investment analyst to run a complete, deep dive stock analysis. We are putting Westamerica Bancorporation, ticker symbol WABC, through the ultimate investing gauntlet. And we aren't just glancing at standard metrics, no way. We're applying the rigorous, time-tested frameworks of literal legends, Warren Buffett, Peter Lynch, and Benjamin Graham, plus some hardcore discounted cash flow and comparative models. Let's get into it. Here's our roadmap for today. We're going to start with a quick company snapshot, run it through the lenses of Buffett, Lynch, and Graham, crank out our DCF and alternative models, and then wrap it all up with a final synthesis and recommendation. All right, Section 1, Company Snapshot. Let's set the stakes. So, Westamerica Bancorporation is a California-based bank operating commercial banking and trust offices throughout Northern and Central California. Right now, they're trading at $58.78 a share, boasting a market cap of roughly $1.3 billion. But, they're navigating a kind of tricky environment at the moment. We're actually seeing a shrinking loan book. Their total loans dropped from about $834 million in Q3 2024 down to $726.5 million by Q4 2025. Yet, despite that drop, they continue to report these incredibly robust profit margins. And here is what's truly fascinating about them. A massive 46% of their deposit base consists of non-interest-bearing checking accounts. I mean, really think about that for a second. Nearly half of the money they hold costs them absolutely nothing in interest. Zero. This gives Westamerica an insanely low annualized funding cost of just 0.24% for their loan and bond portfolios. In the banking world, a deposit base like that is absolute gold.
Moving right along to Section 2, the Warren Buffett lens, let's talk moats and management.
Now, you can think of a moat like a giant castle wall protecting a company's profits, right? Well, Westamerica's dirt-cheap deposits provide exactly that. It's a structural advantage that is just incredibly hard for competitors to replicate. On top of that, Buffett always looks for honest, shareholder-friendly management. And Westamerica's leadership, they retired about 1 million shares using $51 million in Q1 2026 alone. That demonstrates a massive commitment to returning capital to the owners. Add in a remarkably consistent 45% trailing net profit margin, and yeah, those qualitative boxes are getting checked fast. So the crucial point here is that they easily pass Buffett's quantitative marks too. Buffett demands high returns and manageable debt. Well, as of Q1 2026, Westamerica is generating a solid 11% annualized return on equity, which basically means they're highly efficient at turning shareholder cash into actual profit. And as for debt, the parent company has absolutely zero debt, literally none. With a healthy owner earnings approximation of over $27 million in net income for the quarter, Buffett would absolutely view this as a highly stable cash-generating machine. Okay, Section 3, the Peter Lynch lens. We're looking at the growth phase and price. Lynch famously categorized companies to really understand what to expect from them. So is Westamerica a slow grower? Well, you could definitely argue yes, especially considering those recent declines in their loan balances we talked about. But on the flip side, you could also view them as a stalwart. They boast a very solid 9.8% historical 5-year earnings growth rate, and they reliably pay out a 3.43% dividend yield. For Lynch, stalwarts are that stable bedrock of a portfolio, offering serious downside protection when the economy gets turbulent. Now, Lynch loved the PEG ratio. It simply compares the price-to-earnings tag against how fast the company is actually growing. If we take WABC's trailing PE of roughly 11.2 and divide it by that historical 9.8% earnings growth rate, we get a PEG ratio of roughly 1.14. And since a PEG near 1.0 is generally considered fairly valued, this is a pretty good spot to be in. Coupled with that bulletproof balance sheet we saw earlier, Lynch would likely categorize this firmly in the hold-to-buy territory, especially if you're an income-focused investor. Next up, Section 4, the Benjamin Graham lens. Time to look for that margin of safety. Graham wants big, financially unshakable companies. So let's run his strict defensive checklist. Size over $5 billion? Yep, they have over $5.8 billion in assets. Equity to assets over 10%? Oh yeah, they have an incredibly strong 15.05%. PE under 15? Yes again, sitting comfortably at 11.2x. They show really stable earnings and an uninterrupted dividend record. Honestly, they survive this defensive gauntlet effortlessly. But Graham, he wouldn't just stop there. He'd do the math. When we explicitly calculate their intrinsic value using Graham's famous formula, which is the square root of 22.5 multiplied by the trailing earnings per share of $4.52 and the book value per share of $37.35, we get $61.64. Since the current share price is at $58.78, this actually offers a tiny but very real margin of safety. Graham would for sure keep this on his radar. He'd probably just wait for a slight market dip to widen that margin a bit more before pulling the trigger.
All right, Section 5, DCF and alternative models. Let's forecast some future cash flows.
First up is the discounted cash flow, or DCF model. Relying on benchmark assumptions that forecast future free cash flows and discount them back to today, a base case DCF suggests a massive fair value of $119.74 per share. I mean, that points to severe undervaluation. But we got to be careful here. It heavily assumes those historical 9.8% earnings economics hold steady, which honestly might be generous given their shrinking loan book. In fact, if we run a quick sensitivity analysis and just slightly raise our discount rate, the WACC, while lowering our terminal growth expectations, that fair value quickly drops down closer to $80. So let's build a more complete picture by grounding our DCF optimism in reality. We really need alternative models to double-check our work, so we're going to start with a comparable company analysis detailing peer multiples for Western public banks. Looking at the Mercer data, WABC actually trades at a 12.4x price-to-earnings ratio. That's a slight premium to the California state median of 11.8x, which implies a fair value right around $56 per share. And even if we use a dividend discount model as a second check, evaluating their super reliable 3.4% yield, it points to a very similar mid-50s valuation. So this injects some necessary caution into that sky-high DCF calculation we just saw.
Finally, Section 6, Synthesis and Verdict. Time to make the final call.
When we blend all these insights into one comprehensive table, the story really clarifies. From Buffett's qualitative moat to Graham's intrinsic value of $61.64, all the way up to the DCF showing immense upside at $119.74, and then finally the peer comps reining it all back down to $56.00. We clearly see a bank passing the quality and safety tests with flying colors. I mean, zero debt, 45% net margins, and 0.24% funding costs. Those are incredible strengths. But they are grappling with a shrinking loan book and margin compression that definitely caps any immediate explosive growth. So, what's our final recommendation? Our verdict leans toward a solid hold for the average investor at the current price of $58.78. The dividend and the share buybacks offer great support, but growth is definitely pausing. However, for the defensive Graham disciple or the Buffett follower who just loves a high-margin moat, the big question remains, is this slight discount to intrinsic value the exact moment to trigger a buy? I'll leave you to ponder that one based on your own portfolio goals. Thanks so much for joining me for this explainer, and keep learning.